Hey, everybody, welcome back to another exciting episode of Eggs. Today's guest is Tracy Bissett. Tracy is on a mission to redefine the world's economic future by increasing the financial literacy of entrepreneurs, also known as financial fitness. With over 20 years of experience in the financial and services industry, Tracy can help entrepreneurs across all industries, both on and offline. As the founder of and president and chief financial fitness trainer at Bessett Financial Fitness, Tracy helps her clients understand and improve their level of financial fitness with a goal of increased confidence using their financial skills so they can be successful in their financial lives. So without any further ado, because I need this and so does Mike, welcome our guest, Tracy Bissett.
Thank you so much, Ryan and Mike, for having me. I'm really thrilled to be here.
Yeah, not a problem. Thank you for making the time for us. Really appreciate it.
Yeah, always glad to have somebody who's an expert in this financial space. It's interesting. Mike and I spend so much time working in and around entrepreneurs and startup founders and CEOs, people that we've had on the show even. And it seems that so many of them, especially early in their careers, struggle with money and, end up spending a good portion of the middle part of their life sort of solving the problems of their past.
Well,
so
I think it comes a lot with our industry. We're more creatives and numbers aren't really our thing. So we kind of just put it off to the side and ignore it and hope it doesn't bite us in the ass.
Yeah. So anyway, so let's talk a little bit about your background, Tracy. Where do you come from? How did you get into this space?
Absolutely. So ever since I was a kid, I was pretty entrepreneurial. I liked money from a very young age, and my family had everything that we needed. But when I would ask for money to go to the store to buy like a slushie or some chips, I was told, no, we don't have money for that. So I would go out in the neighborhood and I would do things to make money. I had a neighborhood newspaper. When I got a little bit older, I had like a property management business looking after people's houses and pets when they were gone away. So I knew from a pretty young age that I liked money and I wanted to be able to use it to do stuff I wanted to do with things with. And that's really a big thing that comes up for people is how you're raised with money, what you think about it. So I went on to business school after high school. I have a Bachelor of Commerce. I went on to do MBA, and I am also a CFA charter holder. So lots of formal education around money. I got into banking, and so I worked directly with entrepreneurs to help them get the financing they needed for their businesses, all different industries, all across Canada. I grew up on the East Coast in Cole Harbour, Nova Scotia, which a lot of people may know is where Sidney Crosby is from, the hockey player. So it kind of put it on the map. And now I live in Toronto. I've also lived out west in Canada. So as a banker for about 16 years, working directly with those entrepreneurs or actually approving loans for entrepreneurs. And so across all industries, all across Canada, even agriculture, they sent me to agricultural college for a while so I could learn about all those industries. And then about 3 years ago, I started my own business, which is Bessett Financial, where I really do financial education, coaching, consulting with young adults, entrepreneurs, and I also work with financial institutions. So it's really fun. I took all of the things that I like to do in my life. I really like helping people. I like helping take the mystery out of money, and I made it into a business so I could have fun every day.
That's awesome. I'm really excited for this conversation because I'm actually right in the process of starting a new business. And some of the questions I have as far as accounting practices for this business specifically, you'll be able to help.
Hopefully. You might have noticed I didn't say I was an accountant.
Yes.
So you will see.
Get that disclaimer out there.
Yeah.
So let's dive into this. I just barely set up an LLC and I set up a DBA for two different businesses that I'm doing. And I jumped into this kind of like YouTube wormhole of best financial like bookkeeping practices. And there's this new one trending that's called profit first accounting. Have you ever dealt with that? Is that like every video that I watched, it referred to something that was like HST, and I think that's something specific for Canada.
It is absolutely.
Is that an accounting practice that's big in Canada and not really applies in America, or is it something that I could actually use in my business here in the States?
So HST is really, it stands for harmonized sales tax, and that's how our government takes their lump of our money. So it's just one of the taxes that we pay. But certainly, I think standard accounting practices are prevalent in both Canada and US. So profit first might be the approach to the reporting and being able to see that disclosure a little bit easier. But I would suggest there's a lot of other things you want to focus on as well. And for me, the big thing is really cash flow.
Okay.
Because you can be highly profitable on paper. You can have a lot of sales and you can have expenses and look like you're making a big profit. But if you don't ever get paid, you're going to go out of business pretty quick. And depending on the industry, that can happen more quickly than in others. But over the course of my career, I've seen businesses go under in as quick as 90 days because they were doing a lot of work, but nobody was paying them. So it could happen in a service-based industry where you're a lawyer and you're just not collecting for all the work that you're doing, and all of a sudden you're going to write off a lot of that billing that nobody paid for. In some other industries, it's a little bit safer, like something like event planning, where you take big deposits up front. And then you make people pay the day of the event, or you don't kind of carry on with things. So different industries, different structures. Construction's a really high risk industry, people who are building stuff. You guys mentioned kind of off the top that you're in creative industries and maybe numbers aren't your thing. I'm going to challenge you whether that's really the case or it's just something you like to tell yourselves, because I think everybody can learn. And if you put your mind to it, you certainly can pick up some things and move kind of from the getting started phase on that financial fitness spectrum over to the right where you know more things. And it's just learning one small thing every day.
Yeah. The more I dive into it, the more I research it, the more I'm starting to like it. I'm like, oh, this really makes sense. I should have been following this for the last 20 years.
Well, and it's so funny how so much of it too is just paying attention, right? I mean, I remember when I was really young in my business, I had every invoice, and when the check came, I took a photocopy and stapled it to the invoice. And, I had this great accounting practice at some point. And actually, I don't know if it's for better or for worse, but I hired a CPA and I hired a bookkeeper and basically took my eyes off the ball. Like, I just wait for people to tell me stuff now. And I found I've gotten into a lot of really bad habits as a result because I'm not really watching those numbers. So now I'm surprised with things when they show up instead of paying attention. So I think it is really important to, develop good habits, but also, balance your interdependence on people who are or providers who are servicing this stuff.
So on
Absolutely. And I would say entrepreneurs kind of fall into two camps. They're either head in the sand, I can't do it, it's too hard, I don't know about numbers, or I'm just going to let somebody else handle it. And then they'll tell me if there's a problem. And so that's really great, Ryan, that you've recognized that maybe that's not working so well for you. Because even though you can outsource and delegate the bookkeeping and the accounting, you still are accountable for what those numbers say and using them to make your business as profitable as you want to. So you got to know the numbers.
Yeah. And I think that, this year, 2019 in particular is going to be a great example for this because so in my particular situation, our business grew a lot, 200 or 300%, and we had this huge spike in income. However, our CPA, who is actually kind of on the way out at this point, is, didn't bother to tell us about any sort of adjustment in tax payments and things like that. So all this money was coming in and just, again, it was just kind of being funneled off and handled by bookkeepers who were talking to CPA and kind of keeping me out of it. And now I just got the profit and loss this morning. That's why this is really high on my priorities because I'm seeing how much more money we made. And even though expenses and everything went up, we cleared a lot more money, but we didn't pay a lot more taxes. And so now I'm terrified to go meet the tax man because I think it's going to be problems this year. And but I think the point is because I wasn't paying attention and because I relied on these people who are supposed to be giving me the advice, maybe I gave too much power away and didn't keep enough, in my own court.
Yeah, and just so you know, you're not alone. This is a pretty common thing. I see it pretty regularly with the clients that I work with. And the good thing is you can change it. So at a minimum, you want to start having a monthly meeting with your bookkeeper. You want to be going through the numbers with them. And then maybe you have a meeting with yourself, or if you have other partners in the business, you have a meeting with them to talk about okay, now we've got the numbers, we're sure they're accurate, but now what do we do? Are sales trending the way we want to? Are our expenses getting a little bit out of whack? Do we think we need to consult someone else for some guidance on a particular thing? And having that regular cadence of meetings where it doesn't get out of your calendar. It's important just as much as meeting client delivery timelines and all of that kind of stuff. So you can add that, and that's a modest modification to make, and it's not going to change your life dramatically, but it will make you feel less stressed. You're going to sleep better. You're going to feel more in control. And so if you're feeling a little bit of heaviness or anxiousness around money, that's going to lift by virtue of you looking at it regularly.
Yeah, that makes sense. And in this particular situation, like I said, I just got this P&L and was blindsided, right? Like I just haven't been paying attention, and now I'm concerned for how bad it could get.
Yeah. You know, and the tax people, I mean, they're going to take their money whether you got it or not. And those are the one of the two groups you really don't want to get behind with.
Right. Well, and so that might be a place to take this conversation then is overcoming debt. I saw a lot of material on your website, especially for young people in business in your Adulting 101 course, but in some other things, this idea of getting out of debt. And I wonder if maybe you could talk to, speak to some methodologies or some different ways for doing that.
Absolutely. And so the first place I always start, and everyone should start with, what are your goals in your life? And so everybody's are going to be unique. Maybe you want to start a business, maybe you want to travel, maybe you want to go back to school, do something else, but really figure out what's important to you. And then you should be aligning all your financial practices around what those goals are. So if you'd like to start traveling, to bigger trips, more expensive vacations, first you got your goals, then you've set out your priority on them, then figure out where are you? What are all your assets? So all the things that you own that have value. What are all the debts that you have? Because oftentimes people, they forget about some of the debts they have. Maybe they're forgetting about one credit card they have. Maybe they're just purely focused on the student debt they've accumulated. And so getting a true picture of it, and then seeing what's reasonable based on the income that they're making. So there's a couple different strategies to actually reduce debt. First one is kind of start small, pay off the smallest one first, then move to the next biggest one. So it feels like a weight off your mind as you start eliminating these debts in their entirety from your financial life.
Now,
the next one, sorry, go ahead.
Sorry to interrupt. On that topic, as far as like starting with the lowest one and paying it off and then moving to the next one, what I've heard as far as the technique, as far as that goes, is you apply the same payment that you were paying on the small amount to the next bill as well. And then when that one's paid off, you take both payments and apply it on the next smallest one, and it kind of compounds. And all of a sudden your monthly payments that you have been getting by on for the last, 10 years or whatever are paying each one off quicker and quicker and quicker by applying the same payment amount to the next one in line. I don't know if that's what you were intending. I just kind of wanted to clarify. That's kind of what I've heard in the past. And I've heard it works well.
Absolutely, Mike. And that is exactly it. Because you get used to living on the smaller amount. And so then you're actually able to make that meaningful dent in your debt. The other way you can start to approach it is start with paying off and paying down the one that has the highest interest rate. So if you've got credit card debt, that's probably at a higher interest rate than your student debt. And so you may be making minimum payments on your student debt, but you're trying to tackle that credit card debt first. Same concept would apply. Once you get one paid off, then you're going to take whatever payments you were making plus potentially more and pay it on the next one that you're tackling. And kind of the third one, which is a little bit unique, but sometimes people borrow money from friends or family, and there's like this emotional attachment and negative implication associated with it. So if you borrowed money from your parents or your friend, every time you see them, they're asking you, when are you going to pay them back? Or whenever you do something, you feel like they're judging you because you're now out at a friend's birthday having fun, but they are thinking, you didn't pay me the money back. How can you go out to eat? How can you go to a party? And so sometimes it makes sense to tackle those ones with emotional reactions or emotional baggage around them. Get rid of those ones first. So then you can actually improve the relationship and have that person there to support you as you're going through the rest of the debt repayment.
Yeah, that makes sense. Do you recommend doing any sort of like a debt consolidation, like lumping it all into one loan and kind of just taking care of that? Or do you recommend just leaving them kind of where they're at and tackling the highest interest and the high priority ones first?
Couple things on that. So when you see your situation and you see how much debt you owe compared to how much money you make, and maybe your realistic near-term prospects for making money, you might see if it's a little bit unrealistic for you to be able to pay that debt off. And so you could speak to someone like a credit counselor, debt counselor, insolvency trustee to get their take on it and what they think is reasonable. Because you may be able to make a deal on the debt if you owe so much and your income is never going to be sufficient to pay it off. So that's one option. One thing to be careful about with consolidation, though, really important to remember, if you do have any student debt that comes from the government, it often comes with additional rights and provisions within it that can help you. So if you pay out government funded debt with bank financing, you might be losing some of those privileges that you had, like maybe the ability to change the payment terms, maybe to have a little bit of break on it, or interest forgiveness, or anything special that was in there to protect you as a student goes away as soon as you pay it out with just a regular source of debt. So something to keep in mind. And then depending on the tax rules, you may also lose the ability to claim it as interest on your tax return. So it's not as straightforward as just get the consolidation when you have student debt. But for people who are managing maybe 5, 6 payments and it's not special debt like student debt, certainly debt consolidation can be a good thing. You're going to then make that one payment tackle the amount. But as I said, if the debt's just too much, you might need to try to make a deal with your creditors.
Yeah, makes sense.
And they're usually receptive because they'd rather get some money from you than write it all off. Yeah.
Yeah, that makes sense. What are some of the biggest mistakes that you see young entrepreneurs making when it comes to their finances? Are there any like major things that you see consistently?
Yeah, one I've been seeing now, and I've done a few podcasts on it on my show, which is called Young Money, the advice show for young millionaires in the making. And episode entitled, "Are You Uber Broke?" So are you using rideshare? Are you ordering up food all of the time? If you are, is it kind of taking you beyond your budget because you're not really keeping track anymore? It's all of a sudden just going on your credit card. If you're hopping in the rideshare with your friends and it's your account that is going on and everyone intends to give you the $5 or whatever it is to pay their share, do they actually pay you? Or are you now carrying the debt burden for your friends and you're actually harming your situation? So that would be one thing, kind of this mindless spending and taking convenience too far. I've been seeing some crazy stories, even just 15, 16-year-olds. They've got access to their parents' rideshare or food accounts, and they're just racking up thousands of dollars a month. And so that's on the parents. They haven't explained to them how this actually works and kind of put their foot down. But once it's your money, you really want to be mindful of that, because certainly if it's food you're ordering, usually the restaurants have a minimum, then there's going to be the surcharge on for the delivery company, and you're paying sometimes 2-3 times for what you actually would get if you went over there yourself and got it. The other thing I constantly see is people thinking they don't have enough money to actually invest. And so while you may have student debt, I think it's a great time to start saving for future things, even if it's $10, $20 a month. Start doing that, start the practice, because people always think, well, I'll do that when I have more money available to do the investing. But why not learn how to manage your money, learn about investing when you have a small amount, so then you're even more equipped when you have a larger amount. So that would be 2 things. And the third thing is probably kind of overuse or misuse of credit cards. And generally young adults, I find, and the research shows it, that they don't necessarily have the notion of what is the credit card and that they do need to pay it back. So oftentimes when credit card companies are going on campus to colleges or universities, people are signing up and they get this and they kind of think it's free money. Doesn't really set in that they're going to have to pay this back in a month's time or something. And so they may be getting out of school with bad credit scores, which could harm their ability to even get an apartment. Certainly could impact when you apply for a job. Sometimes they do credit checks. So that's a couple of things I'm seeing.
So, something I wish that my parents would have done with me is really sit me down and teach me about money at an early age. It's something we didn't really talk about, something we didn't really go over. And I think it did exactly that for me coming out of high school. I just took a credit card here, bought a car there, did this, and all of a sudden I'm 30 grand in debt and I'm 21 and have no job. And so what are some things that you can teach your kids, or practices that you can kind of use to kind of teach them about the risk of taking on debt, and how you can kind of maybe get them in the right mindset going into high school. I actually wish they would teach it in high school, have a class that actually goes over financial literacy and teaches you principles, balance sheets and cash flow statements and profit and loss, all that stuff. They should teach it in high school, but they don't. Um, as a parent, how could you teach your kids to be financially literate coming out of high school? Are there any things that you would teach your kids?
So first and foremost, I think people should learn about money as young as they can. And so as soon as child's living and they're functioning in life, there should be small money lessons all the time. So I don't think we need to wait necessarily till high school. I think at every age, there's something that you can teach them. I've had a 5-year-old tell me that money is evil. When I was volunteering, like with the little girl guides, and I said, what do you guys think about money? So imagine what's going on in her house that makes her feel like money's such a bad thing. There's probably crying or screaming or yelling, or there's like people calling all the time, maybe collectors. She's going to take that with her whole life, and how she transacts with money, how she feels about it is going to be shaped. So that can always be changed. And I bet she doesn't even really know what money is. So in terms of lessons, I would say, first and foremost, for parents who are listening, it's not your fault if you don't know about money yourself, because sometimes we're looking to our parents to teach us things they don't know. And so it's okay to get other sources. I mean, there's never been a better time, I don't think, for you to learn about money because of all the access to information. And you can find somebody that you can understand, someone you can trust, either through podcasts, through blogs, through books, TV shows, whatever it may be, YouTube. You're going to be able to find someone that resonates with you, and find someone that maybe you and your child can do the things together, or you're able to appreciate the concepts yourself and then pass them on to your children. I'm a big fan of allowances. I think that's great. I think that there needs to start being this recognition of work for money, and how does that look? And when you start doing all the chores for money, you realize you have to work pretty hard to get money. Certainly when you're going into high school, part-time jobs are great. Being able to then look at the paycheck and see, where does all the paycheck go? Because it doesn't all go to your pocket. So being able to see that implication, and then just really having transparent conversations in the house. A lot of students, they just, for some reason, believe, maybe their parents told them this, maybe they didn't, but that their education is going to be funded by their parents. And so earlier on, you can have that conversation about, how am I going to potentially pay for school if I go on, is a really important conversation. And it's going to be an emotional one. It might be parents getting upset. They may feel like a failure if they're not able to pay for that whole education. But post-secondary education is a really expensive proposition now. And the debt numbers are huge. We have really big numbers in Canada, but I know that the numbers in the US are worse. And student debt is a big issue. So have honest conversations, and then actually work together to make plans. So there's so many people out there who can assist. If you're looking at particular schools, go in and talk to their financial aid office. See what programs they have, what offerings they have. Maybe there's scholarships, maybe there's bursaries. Look online for scholarships. There are so many out there, and people generally wait too late to apply. Before Christmas of your final year of high school is a great time to start applying for scholarships. There's going to be a lot less competition, and you probably will win some more than you would have if you just start after Christmas.
Yeah.
So open, honest dialogue is really the key. And when if you're a parent, even with the kids are younger, if you're at the store, you're using your credit card, what does that mean? Oh, I'm doing this. Maybe it's to earn points, and then I go home and I make a transfer and I pay on my bill. Or if you're using direct debit or something like that, explain how all that stuff works. So making everything kind of a teaching moment if you can.
Yeah, I think that makes a lot of sense. So to pivot back a little bit into, I guess it's a little bit entrepreneurial, but I think some of this will sort of still apply to a person in their personal life. What are the tools that you need to sort of understand your financial position? I know for a lot of people, and even from my own personal experience to some extent, when the debt starts to feel too heavy, or the money starts to feel like it's never enough, or whatever, I think there's sort of this natural reaction to just kind of avoid it. Like, we just won't talk about it. We'll just get it out of here. And then, for fear of the reality that, maybe I've got all this crushing debt, versus the idea of, okay, yeah, there's a lot of debt, but let me figure out how to work through it. Like, I think it's a little bit of a mental shift. But can you talk about the tools that are needed to sort of understand your financial position so that you understand where you are in space, so that you can then start assessing costing, looking at profits, and making real money from a business, or, just maybe setting money aside if we're trying to keep sort of, the personal conversation going as well?
Yeah, I mean, the first step is certainly to know the facts. So a lot of people worry about what they think the numbers say, what they think they will show, but you need to start with the facts. If we're going to worry, let's worry about something real. And oftentimes, once the facts are gathered, they're not as bad as somebody might have been imagining in kind of their dread scenario. So that's looking at your bank account. It could be looking at all credit card statements, actually making a list of everything that's out there and how it looks. If, as you mentioned, Ryan, that there's a lot of debt out there, okay, what are the minimum payments I'm supposed to be making? How could I actually tackle this? So there's the what's out there, and then you need to look at what's coming in. If you're an entrepreneur, if you don't feel like you've got enough money coming in sales, or maybe you do have sales, but the cash isn't coming in, what can you do to address that? So can you sell more? Can you get people to pay you a different way, a faster way? And kind of putting those pieces together, and then start actually making a budget. And a lot of people hate that word budget. They hate the concept of making one, but it's really about how much comes in and then how much goes out and when does it have to go out. And most people are living where what's coming in is less than what is going out. So they're making up the difference on credit cards or lines of credit or other sources of credit. Could be even payday loans that they're using to supplement. So if you've got that deficit, what can you do in your lifestyle to reduce that deficit? And for most people, if they've realized there's a debt situation and they've tried to cut back their expenses, it really is about making more money. It's really not, there's not generally so much that you can cut back. Housing is pretty expensive no matter where you're living. Food costs are very high. So there's not as much room to move as people might think, I'll just cut back a little bit. If you're getting Uber Eats every night, okay, that's a different situation. But if you're eating at home, you're buying groceries, probably the key is to make more money. So if you make a little bit more money, maybe you turn on the gas on some of the sales in your business. If in your personal life, you might be starting a side hustle, and one day a week you work somewhere else just to get that under control. And then you're figuring out what would be sustainable going forward in terms of accomplishing the goals that you want, like we talked about earlier.
Yeah, I think that all makes sense. Yeah, I mean, I think for a lot of people, it's difficult to assess. I think to sort of extend the point you made about the ride sharing and things like that, like technology has facilitated such a myriad of things that you can do where you can be spending money and not really thinking about it.
Well, you think about it, you look at like Netflix, you look at like all these subscription-based things that just, you got 10 of them and all of a sudden you're paying $150 on random stuff that you don't even really realize you're doing it because it's $10 here, $15 there, and then all these little things add up and it just, there's $300 gone.
Yeah.
Yeah, especially the apps in your phone, like when you buy like games or certain apps where you have to pay, you probably lost interest after the first month, but you haven't discontinued that subscription.
Mm-hmm.
The other thing too, I don't know about you guys, but Amazon can deliver to my house same day. And sometimes they come more than once a day and it's too convenient. Like you need to kind of restrain yourself when you're just punching buttons on your phone and now you're spending money because it's very easy to get everything that you want instantaneously, but sometimes you just need to leave the stuff in your cart for online shopping. Everybody, not just Amazon, but leave it there overnight. You still need that tomorrow. Because all of that is derailing you from your goals. And I suggest that people, whenever they're making purchases or spending money, ask themselves, does this bring me closer to my goal or farther from my goal? And it's a good way to think about it because it's not, oh, I can't have that. But, it's really more important for me to be able to go on that vacation. Mm-hmm. I'm going to focus on that.
Yeah, no, I think that's great. Well, and the thing that made this so crystal clear for me was I had spent, or like we were just trying to transition into a new bank account, for example, with our business at the first of the year, we wanted to move into a new bank account, clean bank account. I've spent years being horrible about mixing business and personal money. So I wanted a clean start, right? And so I had this idea that I was like, okay, we'll create the new account, but then I'll just close my cards, or like I'll report my cards stolen so they'll get disconnected so that because I've got all these, software subscriptions, I run a marketing and advertising agency.
Yeah.
So we have all these little services, that we use, or different things that we've bought for a client at some point. And then, and so I was like, what I'll do is I'll just cancel these cards, or I'll report them stolen, so the card numbers change. And then, when so-and-so internet provider shoots me an email, I'll just put in the new card information if I need it still. But what I found is that the credit card companies have gotten too smart for that crap. And what they do is they actually electronically send the new card numbers to your people now. And so, at least in some instances. And so there's actually, you can't even shake people that way. And so, like, I've got to actually run to the bank after this and just physically close the account. Like I was hoping I could maybe just kind of retain it and let the last few things hit it that needed to hit it. But yeah, I mean, I can't even just leave it open because it's still being, hit by these random things that I'm finding every so often. So it is incredible the mess you can make online now.
Yeah. And I just want to pick up on one thing you just said, Ryan, because it's really important to make sure you close accounts and that the balance is zero and that nothing is lingering after the fact, because that's the stuff that comes back to bite you on your credit score. And it can create a lot of problems down the road, whether for your personal life or your business life, if your credit score is not good. So being diligent about closing, making sure the balance is zero, having a record of it, because sometimes records get lost and you might need to prove it in the future, that's really the position that you're in.
All right. Let's kind of pivot here. Let's talk about credit and how to use it effectively and how to build credit for a business. I actually, like I just mentioned, I started a new business and I was thinking, I'll go and finance something with the EIN to try and start building credit with it. And I was declined because the EIN was so new and the business was so new that there was no history associated with it. And as I've been doing research, I'm kind of glad that it was declined because there's other routes I should have gone versus going and making that one big purchase to help build the business credit. Some things that I've read up on or researched on is like putting your utilities in the business name, taking like Granger is a starting company that will give you terms for 180 days on smaller items that the terms will actually start reporting to your business, and that'll help build credit with it. Am I on the right track, or are there other things that I should be doing to kind of develop a credit history for the business and isolate it from myself? That's kind of the goal. Is I want the business to pay for itself and keep my credit separate. Do you have any advice on that?
Absolutely. And so I would say you are on the right track, Mike. You do want to establish separate credit relationships for yourself personally as well as the business. Oftentimes when you're starting a business though, and institutions may lend you money though on the basis of your personal credit score. And so sometimes people think, I'll just do it all then in my personal name if that's the case. But you do want to get started and have that entity start having the history and borrowing in its name.
That's actually what they did. Is they went and they tried to run it for the EIN, and then they said, "Do you want to run it on your social instead?" And I said, "No, because I don't want to take that debt on my social, on my own personal account." And it just kind of like, if the object is trying to separate the business from your personal, why would they pull your personal credit and have it tied to the business? That sounds kind of like counterintuitive and maybe even piercing the corporate veil. If that's kind of the idea, is to keep it separate, why pull your own personal credit into it?
So when you think about it, financial institutions, they're in the business of making money. They're not in the business of taking risk. And so when a new company gets started, they're not taking risks on behalf of their shareholders. They need to make sure that they have a reliable repayment source. And with a startup, that reliable source has to be the principal.
Sure.
So it has to be tied to the personal.
So
but then getting the credit in the company name, even though ultimately if there was a problem, it's going to come back to you. It starts establishing the credit history for the business. Because if you have that credit card, all of a sudden now payments are being made on time. There's a track record. And then over time, you can move away from the personal. And at some point, you'd be able to ask and have your personal liability removed from that company. But it's after that track record gets established in the company.
So if I say set up a secure line of credit, I put $500 down on a secure business credit card, and then I get a couple of revolving term accounts like through Granger and a few other ones that are small balances, not very much. And then I put like, Dish and the cable and all the other stuff the internet on the business account. I'm developing those revolving lines of credit and the business accountability. If I do that for like 6 months and then go and try and buy the truck for the business or this or that for the business, is that the right route? Because I don't really, the whole object is trying to keep personal from that. And I could put it on the personal. I just don't want to. Am I doing the right thing? Is a 6-month time frame about on track?
I
I don't know.
think it's gonna take longer than 6 months because it's a brand new entity. It's gonna probably take a couple years for a meaningful amount to then be lent to the company without the personal tie. And if you're thinking about it from the bank's perspective, because I was a banker for a long time, why should the bank have more confidence in the business than the person who owns it? Is
That
another
makes
way
sense.
to think about it. If you don't believe in yourself as strongly and support it financially, why should we? And so I just throw that out there as a consideration. I'm certainly not still bank employed, but I do see it from that perspective as well. I love how focused you are on keeping the personal separate from the business, because oftentimes entrepreneurs are commingling all their bank accounts, like Ryan was talking about, that everything was getting mixed up. And you do want to have that discipline. You want to have separate accounts, even if the money's moving back and forth, personally to corporate and back and forth. That's okay, but you're keeping all of the other transactions separate. So then the record keeping is easier. It's easier to do your taxes. And over time, you will develop that credit history. The big mistake I see with entrepreneurs is they wait until the business is really growing to try to get the credit in the company name. And they've wasted the time that they could have actually been building up the credit score when the company was more from its startup, kind of in the slower growing time.
That makes
The
sense.
other thing too, we may look for other sources of funds. I mean, depending how fast you want to grow, if you want to do significant growth in the company, you might be looking for investors. You might look for grants or other things that don't need to be paid back, where you can actually get money without having to repay it to anybody.
Yeah, that's I didn't think about the grants or anything like that. I don't necessarily want to scale that way. I'm actually trying to get into real estate, and I would like the business to be able to buy the first property and have it be like that's kind of the step out. And so that's why I'm trying to build business credit with the business account so I can buy property later.
Yeah, it'll depend on the loan to value for the real estate. Like if you're going to try to be at the upper permitted levels of loan to value borrowing, there probably will still be some personal component required. If you're going to go at a lower loan to value, where like if the property value fell, the bank would still be okay, then they may go without the personal recourse. But you being tied to it personally, if you're going to be at the max loan to value, say 75, 80% or higher, then it's going to probably require you on the hook too.
So what are the main things that the banks and lenders are looking at for your books and your financial records? Is it the cash flow statement? Is it the profit and loss? Is it the balance sheet, or a combination of both, or all of the above?
I would say a combination of all of the above. So some of the things when they're trying to determine your credit worthiness, and this works for a person or a business, they're trying to see, first of all, what's your character and your willingness to pay back money. If you do a credit check on someone, they've been bankrupt 3 times, and you can see different institutions have lost money. Sometimes that's financial situation, but sometimes it's just willingness. People didn't want to pay. The second thing they're going to look at is your actual ability to pay. So they're going to use that income statement, the profit and loss, to see that. Do you have the means to pay that money back? Personally, they're going to look at your how much income you're bringing in, your tax return. And then they're also looking at things like, if this doesn't go as well as we think, how would we get our money back? And so they're looking at, now the loan is not being repaid. What can we do? Okay, maybe we can take a piece of security. So in a real estate loan, we're going to take possession or force the person to sell the property to pay the money back. Oftentimes that's where they tie in that personal recourse so that they can come and get you to be more cooperative to help them get the money paid back. And it's usually for cooperation that personal component is there. So it's around the numbers, but it's also about the individual and their past behavior.
Yeah, that makes sense. I have a friend that I was talking to him about stuff like this a while ago, and he said something to me that was it like it. He said, fail faster. He said, don't just file for bankruptcy and move on. And that to me just bugs the hell out of me, because I hate the just, hey, I'm going to write it off, move on to the next project and go from there. How bad does bankruptcy actually affect your score? And is it better to just not pay it and pay one lender off over time? Like take the small, because I did that. I had a cell phone store a long time ago, and it closed it down. And I just, instead of filing bankruptcy, I decided I'm going to pay the creditors back, but I did it over time. And I think it hurt me in the long run because my credit was harmed for a longer period of time versus just writing it off and moving on. But on my personal level, I didn't feel comfortable just filing for bankruptcy for a cell phone store. It just, it felt wrong, so I didn't do it. But he was telling me fail faster and move on, and it irks me a little bit. But what are your insights on that? Should someone who's in a bad situation just file and get it over with, or should they wait it out and try and see how things go?
I totally get how you feel about it. And I'm of the same mind, like intellectually, I would always want to pay off my debts. But there is some point where it's not going to be very feasible, and you will do more harm to yourself taking the slow route. Because if you're in such a bad situation where you're not able to make your repayments, your credit score is already negative. Like it's already getting worse. It's bad. You've got probably late payments noted. You've got people probably trying to collect from you. And so you're not doing yourself any favors letting that continue. If you can strike a deal with them versus filing for bankruptcy, I think that's a better way to go. But once you do file for bankruptcy or start that kind of proposal, you're restarting the clock, you're fresh slate. In Canada, it takes 7 years for that to clear off of your credit reports. I'm not sure of the exact timing in the US, but if you're kind of dragging along some old creditors, it could actually harm you longer. But the impact to your credit score has already happened before you take whatever action you've taken. So that it's about being practical and just really pragmatic about how can I improve things the fastest? And sometimes filing for bankruptcy is the fastest route.
Yeah, it makes sense. It just doesn't feel right to me. So
That's
I
right.
just kind of, I had a question. I just lost it. Ryan, you were going to say something?
Yeah, I was going to say, so we had a similar situation. We had a family friend who basically got up to their eyeballs in credit card debt, that kind of thing. And basically was advised to try one of these, I don't even know what they're called. I think it's like a credit counseling service kind of thing, where basically they take on all your debt, or sort of under their guidance, you don't pay, and then eventually they'll negotiate some kind of payment plan for you. And I know that this person took a lot of extra time before getting into that program for the same thing you're describing, this idea that I would rather pay my debts. I don't want to do this kind of thing. Because as part of this program, they basically had to not pay, in some cases, in years. And so, but on this company was on behalf of them negotiating, settlements and things like that. Do you think, is that a feasible option versus a bankruptcy option? Or do you think you're still sort of just extending the inevitable harm?
I think you want to find reputable professionals. There are a lot of people out there who will say that they will act on your behalf and they will charge you fees, and they may not be actually authorized to do all of those kinds of things. So you want to make sure you're dealing with authorized people who can make deals. Where they're legitimately recognized by the government. So that's the first piece. I do think if you can make a deal, that may make it kind of line up better with the values in terms of you're going to pay the creditor some versus all. So if you can strike a deal that works, but if you're dealing with a reputable individual, they're contacting all of those creditors quickly and saying, hey, we want to talk about a deal, not let's not pay them and then see if they'll make a deal. So you want to be careful about who you work with. You don't want to pay fees to people who cannot act on your behalf, who are not allowed, and make sure that you're just checking out those sources. At the end of the day, bankruptcy may still be the best route, but why not explore the other options? And a reputable individual will help you weigh the options. It's not just go see someone for this versus that. They should be able to help you weigh all of the options at once. And do it in a relatively quick time frame too.
Okay. Well, so we've spent a lot of our conversation sort of talking about, I guess, the negative, what to do when you've screwed up, all this kind of stuff. And I think that is where most of our heads go when we're talking about money, or at least that's where my head goes because I'm not very confident with it. But I think there's also the other aspect. What are entrepreneurs or individuals doing right with their money that they may not even realize and or be giving themselves credit for?
Absolutely. And so most times when I work with entrepreneurs and it's a financial education mandate, I'm helping them understand the numbers, plan for cash flow. They'll usually start off by telling me they don't know anything about money. And I said, well, you know what? That's probably not true. So if you've been in business for any period of time, you know how to manage cash flow. You might not do it properly. You might not know the terms to describe it. But if you're in business and you've actually been functioning, you do know how to do it. Because if you didn't, you would have already gone bust. So first thing is look for small wins. And if you are running a business, you are managing your cash flow. So that's great. Secondly, I find that when I start asking questions, business owners, they know a lot about their business. They just don't know how it shows up in the numbers. So I can tell a story from reading the numbers, but I certainly need the input from like both of you. So if I start talking about profitability on a certain service or product, you're going to rhyme off all the costs that go into it. And you know it because you're the one negotiating all of those things. And so we might find that you're not making as much money as you wanted, but you haven't been ignoring all of that. You've consciously been involved in all those decisions to get it to that point. And so I think that there's tons of stuff that entrepreneurs are doing well, especially if they've hired a bookkeeper and an accountant, where they're outsourcing the things that are not their strengths. People start businesses because they are excellent and passionate about whatever they do. Most times that has nothing to do with money, and they didn't have any training about financial matters or money in itself. So I think entrepreneurs need to cut themselves a little bit of slack. I don't like to see so many heads buried in the sand, but if you can pull your head out and admit you need some help, get the help. And then you're just going to make your business grow even more. It's going to flourish once you've got kind of that fine tuning on the financial aspect.
So for a business owner who has filed their own taxes for the last 10 years, is it advantageous or smart to have a bookkeeper just go and do an audit over the last 10 years just to make sure you did it right? Like Ryan just did recently, I started the new LLC specifically to close my old books and start fresh and move on from there, because I was guilty as well of commingling funds, and it's just laziness. You grab the wrong card and don't pull the other one out. You just don't put it on the business account. I'll write it off, which you probably shouldn't do. Should you do an audit on yourself? Should you have a bookkeeper and a CPA go back and look at your taxes and make sure that, you did it right, A, and B, maybe you didn't get a good enough return out of it? You could probably help yourself out. Is that smart? Should I do that? Is what I'm getting at.
I say, like with anything, there's kind of be time and money involved. So how much would you have to pay that person? You have to actually start thinking about, like, what are the odds that you did so many things wrong that it's going to lead to you could refile and actually recover some money. So I think if you thought you were really off track, maybe you do 2 or 3 years at the most. Sure. I don't think you're going to go back 10 years necessarily. But if it's going to cost you a significant amount of money, just cut your losses, move on, hire someone to do it properly, and start fresh from there. When I'm working with entrepreneurs, I typically find lots of errors in the bookkeeping, and then they get on it right away, and then they're moving ahead fresh. If there was some really unusual things or things that were quite wrong in the last couple of years, you would want to fix them, especially if you are going to apply for financing, because a bank is going to look for at least 2 to 3 years financial statements history, and they want to know that those are reliable and credible. So it'd be worth it in that kind of instance. But I don't think there's any need to go back 10 years.
Okay. On that note, I brought it up a little earlier at the beginning of the conversation, the profit first accounting model. A lot of people are talking about it on YouTube, and I don't know if I can trust YouTube, and I got a professional in front of me. So I want to ask you, is that a viable model? Is that something that is going to, if I do that model and do the profit first accounting method, is it going to hurt me when I go to apply for a loan, or should I just do the conventional standard, profit loss statements, everything like that?
Yeah, I think that you want to do your accounting the way you need to, based on the accounting regulations. But I think for your own purposes, you certainly can do different structure of reports where you're seeing the information laid out in a different way. When you think about your taxes, we were talking about that earlier, that's going to be driven based on the accounting standards and the rules from the government. So you want to make sure you're never getting away from that. But certainly for your own self, like you should have a financial dashboard. If you think of just like in your car, your oil, your tire pressure, your gas, what are those bright lights in your business, and have reporting that speaks to that, as well as what's going to keep your eye focused on the profit. Too many entrepreneurs I see, they focus too much on the top line. So what are my sales? And it doesn't really matter what the sales are. You can grow and grow and grow, but if you're not profitable at the end of the day, it doesn't matter what the top is. True. So I think there's a lot of value in being focused on profitability. And usually in my work with entrepreneurs, I see lots of room to move prices up, to make better margins, and for entrepreneurs to get paid more, because they're not making enough money. So then they're not taking enough out and getting paid properly as they should. And True. You start your business to get paid. So how,
I know this is a stupid question or dumb question, but there's people that might not know. How do you pay yourself as an employee, like as a business owner? Do you just write yourself a check, or do you have to do withholding, or do you, I just kind of do a transfer. I've just been doing like, I need $500. I transfer $500. Am I screwing myself over? Should I, you know what I mean?
So there's essentially 3 ways you can pay yourself from a business if you've got a corporation. So you're going to either take a salary. So you're going to have that regular deduction. And it's good before the beginning of the year to talk to your accountant about what is it reasonably I'm going to take, so that you can make those remittances when you need to the government. Another way is after the profit happens, you can take dividends out, which you don't need to decide until the end of the year, but you can be taking out money through the year that you notionally are going to use and call dividends. And that's at a different tax rate. And then the third way is actually to take a shareholder loan out of the business. So oftentimes when people start their business, they put money in through a shareholder loan. So it might be through a repayment of a shareholder loan. And typically there's no tax involved in that. So there's nothing required for the government to.
So my previous business was set up as a sole prop, and I'm asset heavy. So I've got a lot of equipment. And I'm going to be pulling that equipment into the LLC I set up under a DBA that's going to be operating, as its own kind of thing. Would that be considered that essentially? Would my assets be considered, the seeding money for the business?
That is how some of the value is getting in there. I mean, certainly the value at which you transfer it at is going to depend on the age of it and the accounting rules, because there's going to be a certain life attached to each type of those assets. So, but that is a way that you're building up that equity in the business.
Okay. So if I'm equipment heavy and I'm pulling it in and it's equipment I've had for 10 years, does it matter? I mean, because I still feel that there's value. Yes. Okay. All
so
right.
that when it goes into the new company, it's going to be based on accounting rules in terms of what's the value. So it might actually show up with very little book value is what they call it. But in real life, you may be able to use it for another 10 years and you could sell it, but on paper. So depending on the rules, you may be able to get appraisals for those pieces of equipment and actually bring them in at the value you think you could sell them for now. Okay. Or use some comparables, like you go online and it would be pretty readily available if it's common stuff that other people would have.
So I've gone through and I've got a spreadsheet with the serial numbers, the purchase price, the current estimated value, and this and that. I've just been putting that all together to take to a bookkeeper and get that set up. Are there other things I should have available to take to the bookkeeper and say, hey, here's everything I've got? What should I have ready to go to meet with a bookkeeper or CPA?
Just around the equipment piece or around
in
everything?
General, as I'm going and I'm having a consultation with a bookkeeper. What should I have ready?
I would have all my, probably a year's worth of your bank statements, credit card statements, have it all with you. That spreadsheet that you described sounds really great. And that would be the pieces of information that they would be looking for when they're trying to determine that asset value. So it sounds like you've done a lot of the legwork. I think in a lot of situations, they would have to do that legwork that you've already done for them, which is fantastic.
Okay.
Yeah. I think you also want to be ready to talk about how do you want to get paid? How much do you think you might take out of the business in the coming year? So then you can get ahead of how might we do it? It's not being cast in stone, but how might we do it? And if we're doing it some on salary, what is going to be the tax implication to that, and what remittances would I have to make? Because they can give you a schedule then at the beginning of the year, so you can make sure you make those payments on time.
So there's, you see online, there's a bunch of bookkeeping solutions, like $20 a month, we'll do your bookkeeping, or, I haven't looked at the prices, but you know what I mean? Is it better to have a personal face that you go to and and you work with, or can someone just do the online thing and be okay?
In my experience, I've seen a lot of bookkeeping disasters, I would say, and I've seen a lot of people waste money on bad bookkeepers.
Okay.
And actually bad accountants.
How can you vet a good or bad accountant? How can you tell the difference? What should you ask? What kind of questions should you be asking?
I think the best place to start is actually to get a referral from someone you know and trust about a bookkeeper or an accountant. And the more people who kind of point to the same person, you could go to like your local chamber of commerce. You could go to other reputable sources, even to ask at lending institutions, who do they trust in the community? And they don't necessarily need to be local. They can be one of these virtual services, but as long as somebody's worked with them already and knows that they're valid. It's very hard until somebody actually does your records for you to get a good sense of if they're doing it right or wrong. And I think it'd be hard for a business owner to just get that comfort by asking questions, because people will tell you everything you want to hear in that moment.
Sure.
Yeah.
So obviously you got the CPA firms and you got the bookkeepers. Is it better to hire a full-on firm and just handle everything and let them do your payroll, do all this, or can a basic bookkeeper do most of that and then you just go meet with the CPA once a year kind of thing?
Yeah, if you have a good bookkeeper, they can do most of the things themselves, and then you meet with the accountant. As your sales get bigger, you probably want to meet with the accountant more often. But if you've got a good bookkeeper, they can handle all that other stuff.
Perfect.
Yeah.
Great. Well, as we're coming to sort of the end of this thing, where can people learn more about you and the services you provide, which are many? How can they learn about you, follow along, see the content you're putting out, and so on?
The best place to find me is in LinkedIn. So I would invite anybody who's listening who wants to have a chat to send me a note in there. And then I have a gift for everybody who's listening, for those business owners who are kind of wondering, how do I get started with the money piece? How do I make it a priority? How do I make it a routine? So if you go to cashcoach.biz, you'll be able to download a money meeting agenda that will help you get started. As we talked about with Ryan, having that, whether it's monthly, whether it's bi-monthly or weekly, a meeting, this agenda gives you a really good place to start. And even if the first meeting is just looking at the agenda, just start getting comfortable with the money piece. So cashcoach.biz, and you can download that there. And it'll give you the option to get into my mailing list to hear from me often.
Yeah. And you also have a podcast, right? What's the name of the podcast and where can people find it?
Young Money with Tracy Bissett, and it's the advice show for young millionaires in the making. So if you go onto my LinkedIn, the link will be right there. But it's anywhere podcasts are played, and it's a weekly show. And I try to make it fun about money. So I just had one for the Super Bowl around what we could learn from J-Lo and Shakira to be financially fit. So I can make anything fit the money, and I love music, so I have a lot of musical themed podcasts.
Yeah, I actually tuned into one the other day, and I really enjoyed
Maroon 5. That was one of my favorite ones.
Awesome. Well, thank you so much, Tracy. We really appreciate you doing the show. And everybody check her out. It's Tracy Bissett it's BessettFinancialFitness.com. And also check out the 5-step cash flow document that she was just talking about at I lost it.
It's cashcoach.biz.
Cashcoach.biz. That's perfect. It redirected, so I lost the URL. So sorry about that. So anyway, but thanks again so much for coming on the show. We're grateful for your time. And for everybody who listened to the podcast this week, thanks so much for joining us. Make sure you take advantage of the offer that Tracy's given you. And hit us up with any feedback, anything like that you might have, questions you'd like to relay on, or get connected to Tracy directly via LinkedIn. So thanks to everybody, and we'll see you next time.